The United States government has just tipped its hand, and almost no one noticed in real time. For the past several days, investors have been glued to the COMEX ticker, watching silver churn violently around the $90 level. Charts have been dissected, dips have been bought or sold in panic, and endless debates have raged about whether the silver bull market is finished. But while the public was fixated on flickering screens and short-term volatility, a far more important signal quietly emerged from behind the scenes. The United States Mint, the sovereign authority responsible for producing the nation's official coinage, made a silent but extraordinary move. Inside its internal pricing system, the Mint drastically repriced silver. This was not a routine adjustment, not a marginal premium increase, and not a marketing decision. It was a confession. Confirmed reports show that the Mint has repriced the proof American silver eagle at $173 per ounce, while the uncirculated bullion version has been repriced at $169. Let that reality settle in. The so-called spot price flashing on financial screens sits near $90, yet the official government price for physical silver is nearly double that level. This represents a premium approaching 100%. This is not just a premium, it is a sovereign leak. It is the moment when the institution that issues the currency quietly admits that the currency itself is no longer functioning as advertised. Skeptics will immediately object. They will say the Mint is currently suspending sales. They will argue that because coins are not being sold at this moment, the posted price is meaningless. In reality, it is precisely because sales are suspended that this price matters more than almost anything else in the market today. Ask the obvious question: why would a government agency that is refusing to sell coins due to a pricing backlog take the time to nearly double the internal price? The answer is simple and deeply unsettling. They are front-running reality. The Mint knows that when sales resume, whether next week or next month, they cannot sell silver at $90. If they attempted to do so, inventories would be instantly wiped out. They would be handing over a strategic asset for pennies on the dollar. By setting the price near $173, the Mint is signaling where it believes the true clearing price of physical silver actually resides. They are openly telling you that the $90 paper price is a fiction, a derivative illusion disconnected from the real cost of replacement metal. This action exposes the existence of a two-tier market. In the first tier, paper traders on Wall Street exchange digital contracts back and forth, pretending silver is worth $90 an ounce. In the second tier, the physical market operates under an entirely different reality. Mints, dealers, industrial buyers, and long-term holders understand that if you want actual metal you can touch, store, and use, you must pay dramatically more. When the spread between paper and physical reaches $80 per ounce, the exchange is no longer discovering price. It is discovering insolvency. Now consider the psychological impact of this revelation. If you are a retail investor and you see the United States government pricing silver at $173, are you going to sell your physical holdings at $90? Of course not. You are going to hold. You are going to wait. You are going to recognize that your asset is worth far more than the banking system is willing to pay for it. This single repricing move annihilates the liquidity of the short sellers. Banks rely on a steady flow of sellers to cover their positions. But the Mint has just broadcast a message to every silver holder in the country. Do not sell. Hold on. This has unintentionally created the ultimate diamond hands narrative at the sovereign level. The timing of this event makes it even more explosive. The repricing occurred on a Friday afternoon, immediately after a massive attempt to smash the paper price failed. Banks drove silver down to $86 in a violent flash move, triggering stop losses and fear, but they failed to break the market. Silver closed the week above $90, marking the first weekly close above that level in history. In response, the Mint raised its price to $173. This is not coincidence, it is escalation. What we are witnessing is a war between two forces. On one side stands the deflationary pressure of the paper market, desperately attempting to suppress prices to protect the dollar system. On the other side stands the inflationary reality of the physical world, where higher prices are required simply to justify production and secure supply. By pricing silver at $173, the United States Mint has chosen its side. They are aligning with inflation. They are admitting that the purchasing power of the dollar has eroded so severely that a single 1-ounce coin now costs nearly 200 units of currency. This is what a currency crisis looks like in real time. It is not an overnight collapse to zero. It is a sequence of sudden repricings where real assets jump dramatically to reflect monetary debasement. We are living through the great repricing. The screen says $90. The Mint says $173. Only one of those prices allows you to acquire real metal. The paper price is merely a coupon, and that coupon is approaching its expiration date. But the Mint's repricing was only the signal. The real action happened in the vaults. While the Mint was updating internal systems, commercial vaults tied to the COMEX were being drained. Friday witnessed one of the largest single-day physical silver withdrawals in the history of the exchange. In the next layer of analysis, the data reveals something far more alarming than price volatility. According to daily warehouse reports from the CME Group dated Friday, January 16th, over 4.2 million ounces of silver were physically withdrawn from COMEX vaults in just 24 hours. To put that in perspective, this equates to roughly 130 metric tons of silver. This is not retail demand. This is not jewelry production. This is a fleet of armored trucks, cargo logistics, and coordinated institutional movement. The withdrawals were not isolated to one vault. Approximately 1.4 million ounces were pulled from Asahi, 1.2 million from CNT, another 1.2 million from JP Morgan's vault, and nearly 800,000 ounces from Manfra, Tordella, and Brooks. This was a synchronized raid across nearly every major custodian in the COMEX system. The most damning detail is timing. This mass withdrawal occurred on the same day silver ES paper price was smashed down to 86. That is not accidental. The banks engineered a flash crash for one reason only, to settle massive physical withdrawals at a discounted price. A $6 drop across 4 million ounces represents roughly $24 million in savings. They smashed the price to loot the vault. Yet the most dangerous number in the report is not the total withdrawal. It is the collapse in registered silver. Registered silver represents metal that is actually available for delivery against futures contracts. It is inventory with a for sale sign attached. On Friday alone, registered silver fell by over 2.5 million ounces, dropping to approximately 120 million ounces. That buffer is evaporating. When registered silver declines this rapidly, it means the owners of the metal are removing it from availability. They are taking it private. They are pulling it off the market entirely. The question is why? The answer lies in what insiders see coming. They are aware of looming policy actions, including potential Section 232 reviews and the possibility of silver being designated a critical mineral. Price floors, export restrictions, or strategic controls would fundamentally alter the market. In such an environment, you do not want your metal sitting in a public vault in New York. You want it hidden, relocated, or exported. There is strong reason to believe much of this silver is being shipped to London or Shanghai. The LBMA is reportedly operating with dangerously thin inventories, and the arbitrage gap with Shanghai continues to drain Western vaults. Banks are pulling metal from COMEX to patch holes in London, but London itself is already strained. This is a game of robbing Peter to pay Paul, and Paul is nearly insolvent. When 4 million ounces leave in a single day, you are watching market liquidity die. You are watching the exit doors slam shut. This brings us full circle to the Mint's $173 price. The Mint understands that the vaults are emptying. They know that if they attempted to source millions of ounces to resume coin production, the metal simply would not be available. It has already been spoken for. The paper market claims silver is $90, yet the physical inventory backing that claim is disappearing at a pace that guarantees eventual failure. At the current rate of depletion, registered silver could be gone in roughly 30 trading days. That timeline places us directly into the March delivery month, historically one of the largest delivery periods for silver. Open interest data suggests traders are standing for delivery in record numbers. They are rolling contracts backward to obtain metal now. If vaults are drained in January and February, there will be nothing left to deliver in March. That is the force majeure scenario. That is the moment the exchange admits it cannot fulfill its obligations and attempts to cash settle contracts instead. But industrial buyers do not want checks. They want silver. The Friday night vault raid was not just a transaction. It was a warning. Insiders are exiting while they still can. Banks are taking delivery. The government is suspending sales. Vaults are bleeding metal. If the largest players in the world are abandoning paper claims in favor of physical possession, the question for everyone else becomes unavoidable. Why are you still holding paper? The great repricing is not just about price moving higher. It is about availability collapsing to zero. And as institutional hoarding accelerates, retail demand is simultaneously surging. Data now shows retail investors have been accumulating silver ETFs for 169 consecutive days. This is the unstoppable force colliding with the immovable object. The retail public is piling into paper claims on silver at the exact moment physical silver is being removed from the system. This collision is the most dangerous and misunderstood dynamic in the entire market. On one side, real metal is disappearing from vaults at a historic pace. On the other, billions of dollars in retail capital are flooding into exchange-traded funds that promise exposure to silver but deliver something very different. This divergence is setting the stage for a violent resolution. We have already witnessed two critical events. First, the sovereign default signal from the United States Mint, which effectively admitted that the real price of silver is far above the paper quote. Second, the bank run on the COMEX vaults, where millions of ounces vanished in a single session. But there's a third force in this market, and it may be the most unpredictable of all, the retail public. For decades, silver was a niche market. It attracted contrarians, hard money advocates, industrial insiders, and long-term holders who understood supply constraints. It was ignored by mainstream investors and ridiculed by financial media. That has changed dramatically over the past 6 months. The psychology of the average investor has shifted, and the data now confirms it. According to recent analysis from the COMEX letter, one of the most respected institutional research firms tracking market flows, retail investors have been net buyers of the largest silver ETF, SLV, for 169 consecutive trading days. That is nearly 6 months of uninterrupted accumulation. It is the longest buying streak ever recorded in the silver ETF market. This is not casual interest. This is not speculative dabbling. In the last 30 days alone, silver ETFs have absorbed more than $920 million in net inflows. Buying pressure is running at more than double the 3-month average. In fact, the current level of demand has officially surpassed the peaks seen during the 2021 silver squeeze. But there is a crucial difference between then and now. In 2021, the buying was a flash event. It was loud, emotional, and short-lived. It burned hot and faded quickly. What we are seeing today is not a flash mob. It is a migration. Capital is fleeing equities, fleeing bonds, and searching for safety in tangible assets. This is a slow, relentless repositioning driven by fear of inflation, currency debasement, and systemic risk. Yet this is where the tragedy enters the story. The vast majority of this retail capital is flowing into the wrong vehicle. Most investors believe that by buying shares of SLV or similar ETFs, they are buying silver. They believe they are removing metal from the market and tightening supply. In reality, they are doing the opposite. When you buy a share of SLV, you are not buying a bar of silver. You are buying a trust unit. That unit represents a claim on silver allegedly held in a vault. That vault is controlled by a custodian, and in this case, the custodian is JP Morgan. This is the same JP Morgan whose vault we just watched being aggressively drained. This creates a conflict of interest of staggering proportions. The institution responsible for safeguarding the silver is also one of the largest short sellers in the silver market. The custodian of the metal is betting against the price of the metal. That alone should raise alarms. This brings us to the true villains of this story, the major bullion banks. Multiple reports and derivative disclosures suggest that large institutions, including Bank of America and Citigroup, are sitting on enormous precious metals short positions. Some analysts estimate that their combined gross short exposure could be as high as 4.4 billion ounces of silver. Let that number sink in. Global silver mining production is roughly 800 million ounces per year. A 4.4 billion ounce short position represents more than 5 years of total global production. These banks have sold paper contracts representing silver that does not exist, silver that has not been mined, silver that has not even been discovered yet. This is the definition of a naked short, and now they are trapped. On one side of the trade, the retail public is pouring billions of dollars into silver exposure, driving persistent upward pressure on price. On the other side, institutional whales are draining physical vaults, removing the collateral that backs the paper market. The banks are caught in a vice. If silver rises to $100, the losses on a multi-billion ounce short position would be catastrophic. At those levels, the mark-to-market losses would threaten bank balance sheets and potentially require a Federal Reserve intervention larger than the bailouts of 2008. This explains the extreme violence in recent price action. This explains the sudden flash crashes, the margin hikes, and the desperate attempts to smash silver down to the mid-80s. These are not profit-driven moves. These are survival moves. Yet the strategy is failing. The 169-day buying streak tells us something critical. Retail investors are not selling the dips. They are buying them. Every time the banks smash the price lower, ETF inflows accelerate. The suppression tactics are no longer scaring investors away. They are inviting them in. This is the unstoppable force meeting the immovable object. The unstoppable force is a public that no longer trusts official inflation numbers, bond markets, or fiat currencies. The immovable object is an over-leveraged banking system built on synthetic supply and fractional metal backing. Something has to give. Based on the vault data, we already know what is giving way. It is the physical inventory. The ETF structure has acted as a buffer. It absorbs retail demand and keeps it away from the physical market, at least temporarily. Authorized participants can meet ETF requirements through leasing arrangements, paper swaps, and accounting mechanisms that avoid immediate physical delivery. This illusion can persist for a time, but it cannot persist indefinitely. Eventually, the disparity becomes too large to ignore. If an ETF claims to hold hundreds of millions of ounces of silver, while physical vaults are being drained to supply Asia, the structure collapses under its own weight. We are approaching the point where paper claims exceed physical atoms by a ratio that historically triggers default. For individual investors, this carries a stark warning. If you are part of that 169-day buying streak and your exposure is concentrated in paper ETFs, you are sitting in the danger zone. You're holding a receipt for an asset that may already be gone. When the squeeze finally breaks the banks, ETFs are unlikely to deliver metal. They will deliver cash. But cash is precisely what investors are trying to escape. The retail public has the right instinct, but the wrong execution. They are buying the map instead of the territory. They are buying the symbol instead of the substance. This enormous inflow of capital proves that sentiment has fundamentally shifted. The public understands that the dollar is losing purchasing power. They understand that inflation is understated. They are voting with their wallets. Unfortunately, they are voting in a rigged ballot box. The Friday night vault raid was the smart money taking physical metal before ETF holders realize what is happening. It was a quiet, coordinated exit from the paper system. So where does this leave the market as it approaches the next trading week? We now have a market where the paper price sits near $90. The United States Mint has effectively priced silver at 173. Shanghai is trading at a significant premium to Western markets, and the banks are short billions of ounces of silver that do not exist. This is a powder keg. Retail buying is the fuse. The vault drain is the spark. The explosion will be the repricing event that forces the paper market to reconcile with physical reality. That repricing level is not $90, and it is not $100. To reach a verdict, we must combine all three forces: sovereign pricing, physical inventory depletion, and derivative exposure. The conclusion is unavoidable. We are staring at the largest pricing anomaly in modern financial history. Look at the numbers one final time. The paper price in New York closed near $90. Shanghai is significantly higher. The sovereign price at the United States Mint is 173. The gap between the paper market and the government, GOES' own valuation, exceeds 80 per ounce. That is not a spread, it is a chasm. If you can acquire silver for $90 when the issuing authority of the currency values it at 173, you are looking at a historic mispricing. But such anomalies do not last. Markets demand equilibrium. Physics demands balance. There are only two ways this gap can close. The first scenario is that the United States Mint is wrong. The shortage is imaginary. The vaults refill and the price collapses back to old levels. Given the data on mine supply, industrial demand, vault withdrawals, and global flows, this scenario is implausible. The second scenario is that the paper price is forced to rise until it meets physical reality. This is the only viable path forward. The paper price always moves last. The physical price leads. Asian markets confirm. Eventually, Western paper markets capitulate. That sets the stage for a potential shock at the open. While markets were closed over the weekend, information continued to spread. The Mint repricing spread. The vault drain spread. Investors across the globe began doing the same math. When Asian markets open and Western markets follow, traders will attempt to front-run the repricing. If the government believes silver is worth $173, then $95 is cheap. $100 is cheap. Even $120 is cheap. This mindset creates a feedback loop that overwhelms suppression algorithms. The verdict is clear. The great repricing has begun. Double-digit silver prices may still appear on screens, but in the real world, that era is already over. The banks have lost control of the physical inventory, and with it, control of the price. Paper can be printed without limit. Metal cannot. What we are witnessing is a wealth transfer from those who trust the screen to those who trust the scale. So what is the strategy in this environment? First, do not sell physical metal. The temptation will be intense if prices spike. Selling at $100 when the sovereign price is $173 means surrendering your asset at a massive discount. Do not trade a scarce strategic resource for a weakening currency. Second, ignore volatility. The banks are wounded, not finished. They will attempt further price smashes to trigger stop losses. These moves are noise. The real signal is inventory, and inventory is collapsing. Third, watch the spread, not the spot price. As long as physical prices remain far above paper prices, the bull market is intact and the squeeze is active. This is the collapse of a decades-long system designed to suppress the price of real money. It will be chaotic, volatile, and frightening. But it also represents a once-in-a-generation opportunity. The United States government has told you what it believes silver is worth. They told you it is worth $173. Believe them. The banks are short. The mint is closed. The vaults are empty. And the screen still says $90. You know what to do.